All right. Well, thank you, Kathy. It's a pleasure to be here with you today. I'm going to focus my remarks on the economic outlook, including how the recent turmoil in banking has affected that outlook. Relative to the Federal Open Market Committee's economic objectives, data for the first quarter indicate that economic output and employment are continuing to grow at a solid pace while inflation remains too high. The Federal Open Market Committee raised its target range for the federal funds rate to 4.75% to 5% at its March meeting. And our statement noted that recent banking developments are likely to result in tighter credit conditions and to weigh on economic activity, hiring, and inflation. We didn't know then, and we still don't know, the extent of these possible effects. So perhaps even more closely than usual, I will be watching the data to evaluate the appropriate path of monetary policy. The sudden failure of Silicon Valley Bank, or SVB, and Signature Bank, which contributed to stresses felt by other mid-sized banks, was a classic bank run, in which the rapid withdrawal of funds by depositors created severe liquidity problems for the bank. SVB was a specialty bank serving the tech sector. Now, unlike other banks, where a substantial share of deposits are insured and verifiably safe, more than 90% of SVB's deposits were above the $250,000 account limit for deposit insurance. Additionally, these deposits were largely from many of the same types of businesses, resulting in additional risk. Chair Powell has directed Vice Chair for Supervision Michael Barr to report by May 1st on SVB's failure, including the Federal Reserve's supervision and regulation of the bank. Based on what is already in the public record, SVB seems to have done a terrible job managing its risk. A bank run that undermines confidence in other banks is the most fundamental risk to the financial system. It is a central banker's worst nightmare. And the Fed, serving as the lender of last resort, was created in part to prevent such a development. Now, the job of the lender of last resort is to provide sufficient funds to the banking system so that depositors, all depositors, can be confident they will be able to withdraw their funds on demand. If depositors are confident that they will be able to withdraw their funds, then a bank run will stop or never start in the first place. Last month, that confidence was fractured when the failures of SVB and Signature Bank raised the possibility that uninsured depositors could take significant losses. As fear of taking those losses spread to uninsured depositors at healthy institutions, it became imperative for the Federal Reserve, along with other regulators, to act. The Fed's longtime liquidity tool is the discount window, by which banks can post collateral, priced at market value, and obtain loans from the Fed at up to 90 days. On March 12th, the Fed created an additional lending tool with the approval of the Secretary of the Treasury called the Bank Term Funding Program, BTFP, which accepts U.S. government securities collateral at par value with no haircuts for loans with maturities up to a year. So just kind of extended the term of lending and made it a little more generous. To date, both of these tools are working well at providing needed liquidity to help banks deal with deposit outflows. In addition, the board, the Federal Deposit Insurance Corporation, and the Treasury Department announced the use of the systemic risk exception with respect to both SVB and Signature Bank to fully protect all depositors. I voted for these actions not because SVB and Signature are systemically important on their own, but to stem the emerging crisis of confidence that could have led to additional bank runs with significant adverse effects on financial markets and the broader economy. The Bank Term Funding Program and discount window appear to have been successful in providing stability to the banking system. In the past few weeks, we have seen deposit flows stabilize across banks, and as a result, the combined usage of the discount window and the new program has moderated. Both tools remain ready and able to provide liquidity to the system, enabling banks to support households and businesses. This success allowed us to focus on our macroeconomic objectives of price stability and maximum employment when setting the policy rate at our FOMC March meeting. Against this backdrop, the FOMC raised the policy rate 25 basis points without causing significant stress to the financial system. To date, that decision we made has been validated. That said, it is unclear to what extent stress in the banking system will weigh on economic activity. If banks feel they need to adjust their business models or are uncertain about the stability of their deposit base or the momentum of the economy, they may tighten credit conditions and curtail lending. Tighter financial conditions or other lending conditions would likely cause households to reduce spending, businesses to pull back on investment and hiring, all of which will help move supply and demand back into better balance and help bring our inflation down toward our 2% target. It is important to note that there were indications of tightening credit conditions this year before the problems emerged in the banking system. In the board's January Senior Loan Officer Opinion Survey, bank officials reported higher interest rates for loans, tighter lending standards relative to the end of last year. These loan officers also said they expected to continue tightening lending standards over the course of 2023. They cited an expected deterioration in collateral value, a reduction in risk tolerance, and a deterioration in the credit quality of bank portfolios, which mirror the factors that contributed to the recent turmoil in banking. The failure of SVB and Signature Bank and related developments might have solidified and pulled forward factors that were already working to tighten credit conditions. Or it may be that credit conditions will now be even tighter than they would have been. I say this because all else equal, a significant tightening of credit conditions could obviate the need for some additional monetary policy tightening. But making such a judgment is difficult, especially in real time. Now, regarding the economic outlook, the data in hand for the first quarter of 2023 continue to surprise me, with stronger growth and job creation than I expected late last year. The FOMC has significantly raised the target range for the federal funds rate to dampen aggregate demand, but U.S. consumers and businesses are showing remarkable resilience. I mean, if you told me we'd raise the Fed funds rate 500 basis points in 1 year and nothing appears to be happening, that would just be shocking. The Atlanta Fed's Gross Domestic Product, or GDP growth tracker, which reflects the most up-to-date data, estimates that GDP grew by 2.2% in the first quarter, in line with many private sector estimates and higher than most estimates of potential growth provided by FOMC participants. This growth would mean that so far, tighter monetary policy and credit conditions are not doing that much to restrain aggregate demand. Some data for March point to some moderation in economic activity. The Institute for Supply Management's ISM survey of purchasing managers indicated that manufacturing contracted in March, and the ISM survey related to non-manufacturing indicated that activity outside the manufacturing sector decelerated in March to a more modest pace. Now, just a few minutes ago, data on retail sales for March was released, which will give us some idea of how consumer demand is holding up. For this and other sectors of the economy, I believe that demand will eventually moderate because of higher interest rates. The solid performance of the economy through the first quarter in part reflects a very tight labor market, which I'm sure you're all dealing with. The jobs report for March showed once again that we have a very strong labor market with 236,000 jobs created and the unemployment rate falling to 3.5%. While still showing signs of strong growth, job creation did cool a bit from the hot readings we got in January and February. And we did get some encouraging news that the labor market is rebalancing. First, labor participation increased for the fourth month in a row. So labor supply seems to be slowly increasing. Some of that's resulting from immigration increases. Second, the report on February job openings showed that job vacancies fell 632,000 to 9.9 million, and the vacancy rate declined to 6%. For job vacancies have fallen 14% since their peak last March. So the job openings data, along with the jobs report, show that labor demand has been falling, which is more evident in declining vacancies than in rising layoffs. Despite all the discussion about layoffs, for the country as a whole, the involuntary separation rate has not changed. So as the labor market continues to rebalance, this should help bring inflation down by reducing wage pressures. Now let's talk about what these developments mean for inflation. Inflation moderated in the second half of 2022, but that progress more or less has stalled toward the end of the year. And inflation remains far above our target of 2%. On April 12th, we got the Consumer Price Index, or CPI, inflation data for March. And it was another month of mixed news. Overall, CPI inflation rose very little, with only a 0.05, only economists go out to like the second decimal point, increase from the previous month due to sharp declines in food and energy prices, with year-over-year increase falling to 5% from a peak of 9% last summer. Core inflation, which strips out food and energy prices and is a good guide to future inflation, that measure came in at about 0.4% in March from the previous month, which translates to an annual rate of 4.6% if it were to persist. It was the fourth month in a row with core inflation at 0.4% monthly or higher. Since December of 2021, core inflation has just basically moved sideways with no apparent downward movement. So despite some encouraging news on a slowing in housing cost, core inflation does not show much improvement and remains far above our 2% target. Whether you measure inflation using CPI or the Fed's preferred measure of personal consumption expenditures, or PCE, it is still much too high, and so my job is not done. I interpret these data as indicating that we haven't made much progress on our inflation goal, which leaves me at about the same place on the economic outlook that I was at the last FOMC meeting, and on the same path for monetary policy. Now, because financial conditions have significantly tightened, the labor market continues to be strong and quite tight, and inflation is far above target, monetary policy needs to be tightened further. How much further will depend on incoming data on inflation, the real economy, and the extent of these tightening credit conditions. Another implication for my outlook and the slow progress lately is that as for now, monetary policy will need to remain tight for a substantial period of time, and much longer than markets are currently anticipating. But there are still more than 2 weeks until the next FOMC meeting, and I stand ready to adjust my stance based on what we learn about the economy, including about lending conditions, other data such as those on the housing sector, personal income, and surveys that provide managers' views of economic conditions in April will come over in the next 2 weeks. So I would welcome any signs of moderating demand, but until they appear, and I see inflation moving meaningfully and persistently down toward our 2% target, I believe there is still work to do. Thank you, Kathy. I'm happy to take your questions.
All right. So I have some prepared questions for you, Chris. Now, you spoke about how you will be watching financial conditions, which is a normal thing for you to do, of course. What types of things do you look for, and what do you look at when you're evaluating financial conditions?
Right. So the main point of our policy over the last year has been to try to tighten credit conditions, make lending tougher, reduce total demand to put downward pressure on prices. That's what we're trying to do, plain and simple. So we're trying to tighten credit conditions. You can do that one of two ways. You can raise the price of credit, which is the interest rate, or the terms of the credit, maturity, your loan to value, other types of underwriting criteria. We've been focusing on the price of credit. What we're now seeing is the financial sector is starting to adjust the terms of credit, which you all may face at some point. So that's what we're really going to kind of look for. We're going to look about changes in risk tolerance for banks through the senior loan officer survey, terms of credit, loan to value. These are all things that we can see whether they're starting to tighten credit conditions or not. Whether you're kind of raising your tolerance for who's going to get cut off, your prime borrowers, maybe less prime borrowers. Those are the things we're going to be looking at to see, particularly if we see a sudden spike or a very abrupt adjustment in these. Because we already saw kind of a trend tightening as you go up, tightening, getting more severe. But if it suddenly accelerates, then it will have a much stronger effect on the economy.
And directly impact us, as we all know in our industry. Our customers are really subject to this tightening. Another question. Can you talk a bit about how tighter financial conditions are related to your views of appropriate monetary policy?
Right. So up until March 10th, when SVB failed, the data that was coming in January and February was just extremely hot. The economy was not showing any signs of slowing down. So at that time, I thought that our kind of terminal interest rate, like where we might think about stopping, was going to have to be much higher than what we projected in December, which was 5 1/8 in terms of the interest rate. So I started thinking we were going to have to go up to 5.5, 5.25 or higher to deal with it. Once the SVP situation happened and credit conditions started to tighten, that takes some of the work off of me. Because if the financial market tightens the non-price credit, I don't have to do as much on the price side to tighten credit. So what that did is it kind of kept me from pushing up my terminal rate and kept it where it was in December. So we're going to let some of this is kind of a silver lining in a bad cloud, but we're going to let some of this tightening do the work for us so that we don't potentially have to raise rates quite as much as I thought we would have to back in February.
It's encouraging that you continue to reevaluate everything after economic data comes in. Some people, don't get to see that part of your decisions.
Yeah. Yeah, we live and die by the data.
Yep. Super data. Yes. All right. You mentioned that inflation is still too high. And so why is it taking so long to get to the 2% target that you said?
Yeah, so inflation's been kind of funny over the last 15 years. During the 2010s to 2020, we had a 2% target and inflation was running consistently below. And it's always this funny thing in economics. If there's one thing a central banker should know how to do, it's cause inflation. But we couldn't seem to get inflation to go from like 1.5 to 2. It just stayed there for 10 years. We couldn't move it. So that stickiness in inflation was a puzzle to all the economics profession. Given everything we were trying to do to stimulate demand, get the economy going, it still just didn't seem to have any impact on inflation. And then we got a big surprise. Inflation went up. For a while, all the economics, all the theory, everything suggested that this would be, I'm going to say the dreaded word, transitory. And then unfortunately, it didn't turn out that way. So inflation exploded on us really at the end of 2021. We had to do an abrupt adjustment in our policy to tighten at a much faster rate because inflation was just screaming, as you saw last year in 2022. And it's my job to try to get it down. That's what put me in there for. So we went on a very rapid rate hike to try to bring inflation down. Now we have seen headline go from about 9% down to about 5%. So that is progress. But like I said, core, when you strip out food and energy, a lot of that run up and run down is just food and energy, particularly energy. So it's not really telling you what's going on underneath for kind of all the other goods and services. That's why we look at core. That's why we strip those two categories out. That's everything else in the economy. And that just has not come down. It has stayed right around in December 2021, I believe it was 6%. And right now it's 5.6. So core inflation has just literally gone like this, sideways. We need to get that down to get closer to our 2% target. So one of the things we do know that's driving this persistent is housing cost, shelter cost. Rents move with a lag because people sign 12-month leases, say for rents, and then they only adjust once a year. But when they adjust, they go up a lot. So you get this lag that a lot of what we saw in housing pressures last spring are just now going to start showing up in prices, new rents, new leases that get signed. So shelter has this persistent component. We all know that. Everybody's fully aware of it. And a good sign we got in the CPI report is that we finally saw, instead of housing shelter costs going up at 0.8% per month, They only went up at 0.5, 0.5% per month. And we expect that to keep coming down. So that should pull some of the persistence. That's why most of us have inflation coming down to like the 3 to 3.5 range by the end of the year. Some of that persistence from housing will start fading away. And then we'll get inflation a lot closer to our target by the end of the year.
Probably the best explanation I've heard of why it's so stubborn, because it just isn't moving. I mean, it's just sitting there. All right, so after months of inflation, and I mentioned this to the other day in a casual conversation, our industry is starting to see some kind of price deflation, especially around commodities. Non-commodity products are still holding, but the commodity prices are starting to drop. Is this consistent with what you're seeing at the macro level? And would you share a broader view on this and what that could mean to us and the general economy?
Yeah, so the pandemic caused a huge shift in spending by households from services to goods. Goods, you got to make stuff, you got to ship stuff, it's got to go on a truck, it's got to go on a plane. So we saw a huge demand for this in the pandemic. Prices exploded for manufactured goods, any durable kind of goods. And then as the pandemic kind of receded, we all anticipated rotation out of goods back into services. That took a lot longer to happen than we imagined. So we were always expecting goods prices, manufacturing good prices. They ran up and that they were going to come somewhat back down. Not maybe all the way back, but come down somewhat. We didn't see that till the end of last year. We were thinking this would happen by the end of 2021, early 2022, but it didn't happen till the end. And in the last couple of months, good prices have started to go back up, not, stay flat or continue to come down. So some of the decline in manufacturing and prices are, some of that is we fully expected this rotation back into services. When you use terms like revenge travel, that should tell you something, that there's a rotation back to services. And the other big disruption was just supply chains weren't prepared for this kind of massive increase in demand and shipping of all this stuff. So there was a lot of talk about supply chain problems, and that we thought in 2021 that these things would unravel quicker than they did. It just took a lot longer to unravel these supply chains or reorient supply chains to help kind of get goods prices back down. I mean, the thing I learned in the pandemic is I thought all the economies would just kind of power down and then just power back up. But, they didn't happen at the same time. Some would power down, some were still going, this would come up, this one would go down. So every time you reestablish one link in the supply chain, another one would break. And unless they're all connected, it doesn't work. So that's why I think there was a lot of persistence in the supply chain, just because this asynchronous shutting down and opening up of economies around the world. But we are starting to see a lot of the supply chain things unravel. I'd be curious to hear if that's your world. Love to hear comments on what you're seeing. But what we're seeing in the data is, for the most part, we're not hearing a lot of problems on supply chain. So what we're seeing right now is pure demand. People have income, their jobs are good, there's a tight labor market, and that supports demand for goods and services by households. So that's kind of how I see it, but I'd love to hear later your thoughts on it.
Well, since we're at that point, and my next question was around supply chain, would anybody in the audience like to comment on what you're seeing around Chris's question about what you're seeing in supply chain? Because you all live it. We know, because my organization's on that receiving end, but you all have lived the supply chain challenges and whatever you're dealing with today. What are you all seeing? If anybody wants to comment.
Yeah, so on the first point, well, the question was, supply chains have gotten better, but there's still spot shortages of products. That's a great point. I heard that, a year ago that, if you need 100 parts to put something together and you get 99, you still can't ship the product. So like during the shortage of vehicles, when they were short chips, at some point the automakers just said, okay, what things in the car do we not need a chip for? And we just sell it without some functionality in the car that we normally would have sold it. Those are the kind of trade-offs you start making when you have the problem you just described. In terms of, this is the tricky part about pricing, right? You negotiate a contract to supply some goods. It takes a while to get there. Prices change dramatically. Somebody either has to, bear the cost if the price isn't right. If it's too high, buyer saying, well, I could have got it lower, or they walk away, or you have to renegotiate the contract. So I'm not sure exactly how much renegotiation there is in terms of your all contracts or orders, depending on how much it is, whether you have to eat it or the customer has to eat it. That's not my world. That's what I want to talk to you all about. But I mean, that's what I said. That's a similar kind of common problem with leases of any kind, that they're set. Last year, there's a lot of inflation pressure that builds up over the year. They reset higher. And then last year, we saw rents were skyrocketing last summer, but rents have come down. I have to reset my own rent here pretty quick. So yeah, it went up to like 15%. It's come down to 8%, but I was at 0. So I got to go up to 8%. So it's still going to be a shock for me when I get my rent increase. And so that's kind of the issue with all the repricing is you're still with a lag, you're still going to have to face these higher costs.
I think we have 2 minutes left. 2 minutes left. Are there any final comments? And if you don't, I have one quick question. It's actually probably won't be quick though.
Fire away.
Okay. What are your views, briefly, on the recent chatter about de-emphasizing the U.S. dollar as the world's reserve currency? We're hearing a lot of noise out there on that.
Yeah, I mean, the thing I always try to stress with the U.S., the reserve currency, the dollar, is this is a voluntary arrangement by trading partners in the world. If you're a German firm trading with a Japanese firm, you price your contract in U.S. dollars. Nobody's forcing you to do that. You're doing that because you want the dollar to be the basis for that trade. So it's always a question of why do people want that our currency to be basis of a voluntary trade between two other countries. And the reason is we have good rule of law, with good property rights, deep and liquid financial markets compared to everybody else on the planet, relatively stable political and policy institutions. And that's why these countries want to use our currency. So I always ask people, if you think the dollar should go down, one of those things has to break. And somebody else has to step up and do it better. My whole 40 years, I've been told, oh, the dollar's going to lose. It's still there. So it's going to be very hard for some country to step in and remember, you can always put a gun to somebody's head and say, look, you got to use our currency to do something in our country. Okay. But that doesn't mean people outside your country who are voluntarily going to use your currency to do anything. So that's why I personally don't think there's really a serious threat. When the euro came into existence 20 years ago, that's all I heard. The euro's going to take over. The euro's going to knock, not even close. Didn't even come close. So the dollar's still the preeminent currency because people in the world want to use it. And that's why it is.
Well, join me in thanking Dr. Waller for joining us this morning. And thank you, Chris.
Thank you.